All right, in this video, we are going to talk about what I believe is the best asset class or the best niche market for retail investors and retail traders to focus on, right? This is kind of like my day-to-day cash flow business where I'm day trading, right? And so here we go. Best asset class to trade for retail investors. What I trade on a day-to-day basis are small cap companies, say under $2 billion market cap. You know, outside again, this is my day-to-day kind of day trading, right? Outside of this, I also dabble in, private investments and venture capital, etc. But what the reason why I think this is the most optimal, I'll go into the reasons why I think this kind of niche market is the most optimal to day trade for retail investors. So, number one, heightened volatility. What does that mean? So, example, Apple is a large cap, right? Large capitalization company, which means it's worth like $1 trillion market cap, right? The problem with trading Apple is because it's so big, it like moves in such small amounts. Its daily volatility, maybe it only moves like 1 or 2% a day, right? It's like boring. You can't make large money out of it unless you have large amounts of money, right? If you're a multi-billion-dollar hedge fund, then sure, 1 or 2% a day on $1 billion is a significant amount of money, right? But for retail, uh, you need more volatile moves, right? So what is the difference between Apple and small caps? Small caps under, let's say, $2 billion. Daily volatility could be like 50 to 100%. There are stocks on a daily basis of these small companies that move 50 to 100% a day, right? And so if if you only are starting out with like $5,000, $10,000, right? In order to make a couple $100, it's much easier to trade something that moves 50 to 100%, right? In order to make let's say make $500, right? If a stock is only moves 1 to 2% a day, you need to buy $50,000 worth of stock in order to try to make $500, right? For a retail trader, you're starting out with a couple $1,000s. I mean, there's no way you can have that much money, right? Small caps, in order to make $50, or sorry, $500. If a stock's volatility is like 50% a day, you only need to put in $1,000 to make $500. Does that make sense? And so this is the first reason why small caps is better for small retail investors, right? Number two, barrier to entry for large kind of trading funds. You know, Wall Street funds, let's say in like if you're managing $100 million, a couple $1 billion, you cannot trade these small companies because they are literally too big, right? If a company is trading like if a company's market cap is like 100 million market cap, you can't just go out and buy like a $1 million worth of stock, right? Because it's so small that just putting out a $1 million order will literally cause the price to go up like 5 to 10%, right? So, from the perspective of the large kind of Wall Street fund managing a couple $100 million, $1 billion, etc., they can't trade these stocks because they're too small to trade. Does that make sense? It's like these large funds are the big sharks and the big whales. The small cap market is like a small pond, right? They literally cannot get in. And the reason why that's a good thing is because you don't want to be trading against these large sophisticated funds, right? You want to be trading against like other retail traders, right? Other kind of smaller traders, even smaller funds, right? You want to compete against, like, for example, um, people talk about trading the foreign exchange markets, right? I think the Forex markets is by far, I think, one of the most difficult to trade. Why is that? It's because you are competing against central banks and governments who have more money than you, who have more insider information, who are more sophisticated and have more kind of like technology, right? So why would you go out your way and make it more difficult for yourself, especially when you're starting out, right? The good thing about the small cap niche market is that it's primarily retail traders, right? You're competing against other kind of independent traders, investors. So I would say for people who have kind of account sizes under $3 to $5 million, this is the ideal market to trade, right? It's like the low roller table in a casino, right? There's no shame in it, right? You start out at the low rollers. Once you kind of graduate, you can move on to kind of more sophisticated, more advanced markets, right? Including Forex if you wanted to do that. So this is number two, barrier of entry for large funds, right? This is number one, heightened volatility. Number three, very low correlation to general market. What does that mean? So the problem with trading a stock like Apple or Tesla or any large cap company that these institutional funds are in is that they are correlated to the general market. What does that mean? The general economy is going up, these stocks are going up, right? The general market is going down, these stocks like Apple and Tesla are correspondingly going down, right? So everything is like moving in the same direction, right? Which is not what you want, right? You you know, it's like you're essentially kind of by indirectly trading the general market if you're trading Apple and Tesla, right? Uh, what you want is something with very low correlation to the general market, and that is the small cap market, right? It doesn't matter if the general market is tanking or the general market is going up like crazy. Every day, every week, there are multiple stocks in the small cap market that move like 50 to 100% on a daily basis, right? It's because these companies, well, this is related, this goes back to number two, right? The large funds cannot get in. The large funds, the Wall Street funds, are responsible for kind of like generating this correlation to the general market, right? The small cap market is primarily retail. It's like the degen gamblers, right, in a sense. And so on a weekly basis, it doesn't matter if the general market is up or down, right? It doesn't matter if we're in a bull or bear market in a general economy. There are stocks moving on a daily basis, 50 to 100% every week. In a hot market, there are like multiple stocks in a day that are moving 50, 100, 200, 300%, etc. Right? And so you want to trade an asset class with low correlation so that you can make money on a consistent basis in any kind of general market, kind of recession, depression, recession, bull market, bear market, etc. Right? You want a consistent income stream. Lastly, short market cycles, which makes it faster to collect data. This is number four. So the general market, the general business cycle is like a 7 year to 10 year type of cycle, right? We're in a bull market like 75% of the time for years on end, and then everything kind of like corrects in like within like a 1 or 2 kind of recession time span, right? That is kind of too slow to collect data. What is trading investing at the end of the day? You're making bets based on statistics and data, right? That hopefully give you an edge so that you can determine when the odds are in your favor, right? You need to trade an asset class that can give you feedback, to give you data points so that you can adjust and kind of revise and improve your trading system, right? As quickly as possible. The reason why the small cap market is ideal for this is because its market cycles are like in the span of months and weeks, as opposed to the general market, which general market cycles 7 to 10 years, right? Small cap market cycle, like in the span of like weeks to months. What does that look like? So let's say some stock goes up like 500, 1,000%, which happens, right? It'll trigger a bull market in this niche market of the small cap space where stocks are just popping off left and right, going up 50, 100, 200%, right? And then that will die down and maybe, some stock tanks based on like terrible kind of like FDA news or something. That'll kind of like cool down the market. So it's the same cycle of like euphoria to depression, but everything is compressed within weeks to months instead of in a general market where the cycles last 7 to 10 years. The reason why this is good is because you are able to collect data points and statistics faster, which allows you to improve your trading strategies and hopefully master the market within a shorter period of time, right? Like imagine if to wait years in order to see if your strategies play out, right? That's like, ain't nobody got time for that. What you want to trade is a a market that allows you to improvise and iterate your strategy so that you can master the markets within a much shorter amount of time. Let's say 6 months to 12 months, right? I believe that's a realistic goal if you have proper guidance and data. It's all about collecting data, and this we will discuss in another video of how to properly journal, right? I developed software. I'm a software engineer, so I've developed a trading journal software that I probably will release to the general public sometime in the future. So even at this point, I collect data on a daily basis. What's working, what's not working, on a kind of like where in the cycle of the small cap space we are in, right? Cycle. Everything operates in cycles. This is like weeks to months, right? You don't want to trade a market that goes in cycles of like years, right? You need data to trade. So to sum it up, these are kind of the 4 reasons why I believe the small cap niche market is ideal for retail traders, anyone with under like $3 to $5 million accounts to trade, right? Of these 4 reasons. That's it for now, and take care.